we are in the early stages of a natural resource bull market, supplies are going to become increasingly constrained. An increase in precious metals prices is, from my point of view, almost inevitable.
Please join us for our next live stream Sunday, January 2nd at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, January 2nd, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe. Hit that bell to be notified on updates and give us a thumbs up if you like what we do. They truly do mean a lot for us, and we thank you for them. Rick Rule joins us once again today. A highly experienced investor and speculator focused on sub-billion market capitalization public and private issuers in natural resource industries. Rick has structured, led, and participated in hundreds of privately placed debt and equity issuances for resource companies operating internationally and in the U.S. He's a sought-after investment conference speaker as well, having presented at hundreds of resource and investment conferences over the last 30 years. And we're delighted to have Rick join us once again today. It's time to saddle up and silver up for Rick Rule. Rick, welcome back to SBTV. How are you doing?
Patrick, it's a pleasure to be back. Thank you for having me back. Life is good, and I trust it is with you and your viewers.
Yeah, life is great. I mean, always could be better, but no complaints, no complaints. Rick, let me start off by asking you, how are things going at Rule Investment Media?
With the caveat that I don't know what Rule Investment Media is going to be when it grows up, things are great. I love being able to produce content now that I've retired from regulated activities. In other words, the content that I can produce is no longer censored by the Securities and Exchange Commission, FINRA, the Ontario Securities Commission. It used to be that I could talk about anything I wanted to as long as it was of absolutely no value whatsoever to investors. And the idea that I can now give an interview like this completely unmuzzled by those alphabet soup agencies is very pleasant. So thank you. We've attracted 75,000 subscribers without trying very hard, which is interesting. And I have no idea what we're going to do when we grow up.
That's okay. I have the same question that I asked myself also. I don't know what I'm going to do or be when I grow up. But Rick, 75,000. What are perhaps the top 2 or 3 things you tell investors when they seek your advice or services?
That's a great question. And I actually did a video on that yesterday, so it's fresh in my mind. The first thing is that most novice investors and speculators pay an awful lot of attention to price, share price, commodity price, all that type of thing, which is easy information to obtain, but they pay very little attention to value. The price of something, I don't think, is very relevant information if you don't have a sense of value. Let's say that you know the price of a share of stock is $10. Well, that's interesting, but it's an abstract number. If you don't have an opinion as to what the stock is worth, the price information doesn't matter for much. If you think that the company is worth $20 a share, and 2 years from now could be worth $40 a share, then the fact that it sells for $10 a share puts everything in context. It's a buy. By contrast, if you think it's worth $5 a share and it's selling for $10 a share, at least you know to avoid it. The problem is that most people have a real good sense of what the price of something is, but no sense whatsoever of the value. And people need to remember, even in times of negative real interest rates, that values matter. Money is made in the delta between price and value. It isn't made in the abstract. The second thing that I would urge people to pay attention to is time frame. Most investors have trauma holding an asset class over a long weekend, probably because they don't have very much sense of the value relative to the price. Interestingly, when I was a younger person, when I had more time left on earth, I had less patience. When I was 21, I wanted something to happen in 2 months or 3 months or 4 months. I wanted the psychological gratification of a rising market. What I learned by bitter experience over the last 50 years is that what my wants don't particularly matter. The eighth wonder of the world and the first wonder of investing is compounding, and it takes time to enjoy compound internal rates of return. So, interestingly, now that I'm 68 going on 69, I have less time on earth. I've become infinitely more patient, I think in 5 or 6 year terms. So I would say that the two most important things that investors need to do is they need to think less about price and more about value. And they need to think in realistic time frames. We need to understand that what we want is completely unimportant. Our aspirations have to be based on things that we can have rather merely than things that we want. And time frame is the biggest mistake that most investors make. You know, Patrick, people are attracted to my speculative advice because they know that I've had some spectacularly successful speculations in the past. And when I tell people that I did a sort of an examination of tenfold returns that I've enjoyed in the past, which is to say speculations that have gone 10 for 1. And what I learned is that the median elapsed time frame in a 10 for 1 was between 5 and 6 years, which means it didn't happen overnight. And interestingly, in equities markets at least, on most of those investments that went 10 for 1, in fact, damn near all of them, at some point in time in the 5 or 6 year period that I held them, they fell 40 or 50% in price. So it isn't merely that I was challenged by time. I was also challenged by volatility. So that's a long-winded answer to your question, but frankly, the answer was fresh on my mind, so I'm delighted that you asked me.
Those are some great points. I mean, I guess especially the patience and having the patience to wait, especially when things get a bit volatile. But Rick, how has the resource space been this year regarding miners, minerals, and metals?
This year's been a very good year for me. It hasn't been a good year in terms of the equities indexes. What it has been is a year where the narrative that existed in 2019 and 2020 fell apart. And the high-quality investments and high-quality speculations have fallen in price the same way that the low-quality ones have. In 2020, you'll recall my saying this in interviews, found in particular the junior resource stock market to be overhyped. And while I saw some companies that were on the face of it attractive, they were overpriced. So I sold them. And I was wondering if, as a consequence of selling them, that I would miss the subsequent bull market. I became nervous about the fact that the kind of companies that I like, more speculative natural resource stocks, were ironically underrepresented in my portfolio. And this caused me some trauma. The market took care of me. And what I have found is that the good, the bad, and the ugly have all fallen in price. And given that I believe that we are in the early mid-innings of a very long precious metals bull market, and the early stages too of a general resource bull market, I have been very happy about what I've seen this year. The next leg in the stool will be when the juniors who played chicken with capital markets last year, refusing to raise money because they thought their share prices were too low, run into the need for capital in 2022. And my suspicion is that 2022 is going to be an absolutely epic private placement market for those people who have the courage of their convictions and are check writers. The terms that have been offered to the public in private placements in speculative markets for the last 3.5 years have been horrific. They've been terrible. And I believe that some balance will come back to the market, that the juniors will experience trouble raising money and have trouble in their aftermarkets. And the consequence of that, an allegedly worse macro environment, will be better for high-quality check writers such as myself. So I have to say that the circumstance that surrounds me has been, from my point of view, pretty close to letter perfect.
You know, Rick, when investors come to you, do they have the same concerns as do many of the gold and silver bugs where the markets may be sort of disconnected through all that Fed intervention?
Yes. Yeah, absolutely. I think people who are attracted to my message are, in some sense, naturally contrarian. And if people listen to my interviews, they have to suffer through a fair bit of arithmetic and not as much narrative as they're used to. So people who are attracted to me are people who are concerned about quantitative easing, which would otherwise be called counterfeiting. They're concerned about debt and deficits. They're concerned about negative real interest rates. I would say that their fault, probably, if I had to assign one general fault, is their time preference. The fact that they haven't yet learned one essential truth that I have learned, that two words in English, inevitable, which is what I think a precious metals market is, and imminent. The fact is that most people who are arithmetic oriented are linear thinkers like I am. They believe that if A is true and B is true and C is true and D is true, that the only possible outcome is X, and that outcome will occur sooner rather than later. And that's where the thesis breaks down. This whole circumstance around the fact that an increase in precious metals prices is, from my point of view, almost inevitable, does not mean it's imminent. Investor behavior has been schooled by 40 years of a really truly benign economic climate. People are unafraid of inflation despite the fact that they're experiencing it. People are drawn to the bond market because the bond market has worked for them for 40 years, irrespective of the fact that in junk bonds they're earning a 4.6% yield with high credit risk in an interest rate environment where they're actually losing 2.5% a year in purchasing power and taking these unacceptable risks. So there's a disconnect between what people are starting to understand and what they've been conditioned to think. This will resolve itself. This will certainly resolve itself. But it might resolve itself over 2 years or 3 years. Sorry for this long-winded answer, Patrick, but I think that people need to understand that if they ask themselves an investing question where the answer necessarily begins with the word when, not if, they're asking themselves very high-quality questions. And for myself, when I examine the arithmetic around either the precious metals thesis or the natural resource thesis, I get to suppose an answer that begins with when, not if, for reasons that are arithmetic rather than narrative. And I'm very, very comfortable about that.
Yeah, it's another great point. Rick, the Fed is going to try to normalize monetary policy. So in your view, I knew there's going to be a laugh in here somewhere. In your view, what is normalizing, and is getting back to 2018, 2019-ish numbers, is that normalizing, or is it going all the way back to November 24th, 2008, the day before QE1?
Patrick, they are not going to normalize. What they are involved in is codifying a set of lies with the intention of making the investing and, more importantly, the voting community believe that these lies are true. Let's examine this. The central tenet of monetary policy worldwide is negative real interest rates and quantitative easing, which is counterfeiting. What they said is that they might work up the courage to counterfeit a little bit less. That's normal, I guess. More importantly, let's look at the normalization around negative real interest rates. Let's strip all the Fed speak out of it. Let's say that you are a young man, which you are, starting out in business, starting out in life. Negative real interest rates means that you forego consumption, you save, and you send me the money so that I can consume now. And you pay me to consume now while you save and take on the credit risk. Does that make any sense? Is there anything normal about negative real interest rates? When they say they're going to normalize, what normalize would mean to me would be that they would let the market take control of interest rates. So let's do a little arithmetic around that, just for fun. The U.S. 10-year Treasury is the world's benchmark security. It's the one that all other securities are priced against. It's been that way for 60 years. The yield on the U.S. 10-year Treasury is about 150 basis points, 1.5%. So you give the U.S. government money, and they give you 1.5% a year for 10 years. And they're going to do it because they can print. But let's look at this from your point of view as a saver. You give them $100,000 at 1.5%. So they give you back $1,500 a year in a currency that they acknowledge is depreciating at somewhere between 6.5% and 8.5% a year. In other words, the US government almost guarantees you that you are going to lose 5% a year in purchasing power for 10 years. Jim Grant describes this as return-free risk. Franz Pick described this type of investment as a certificate of guaranteed confiscation. So, from the Fed's point of view, normalize means that savers are going to subsidize spenders and take credit risk for guaranteed negative real rates of return. Their idea of normal is that you will punish savers and subsidize spenders. The people they represent, of course, government being the greatest spenders and the worst savers of all. That is normal from their point of view. I think if you put it in those terms, that both you and your listeners will agree that their normal is our bizarre.
And Rick, what do you think of the Fed's plan to raise rates perhaps 3 times next year? I mean, what are your thoughts on this as well?
I think they very much have to. I don't know if they can. Certainly, you can't use fiscal policy, at least cutting interest rates, as a tool if interest rates are too low. You can't cut the nominal rate for any period of time below zero. The real rate is obviously below zero. So they, as an example, in the U.S. 10-year Treasury, I suspect that they almost have to get the rate up to 2.2. That'll still be a very strong negative rate of return. And I think that the likely market impact of at least the U.S. Fed successfully raising the interest rate, if they can, will be a strengthening U.S. dollar, and for a period, strengthening confidence. That may result in lower precious metals prices over the period of time that they do that. Although historically, rising nominal interest rates in a period of declining real interest rates have coincided with very strong precious metals prices. If you remember back to the decade of the 70s, as they raised the interest rate, they raised the nominal rate, and the real rate stayed negative, and so gold and silver prices ran over the course of a decade. But certainly in the near term, a strength in the nominal interest rate would result, one would suspect, in a stronger U.S. dollar and weaker precious metals prices. Let's look, however, at their ability to really raise interest rates. If you look at the U.S. 10-year, by traditionally I mean over 40 years, the U.S. 10-year Treasury has offered a real rate of return above the rate of inflation. So if you normalized the rate that they would pay on the U.S. 10-year, and let's use the lower range of their projected inflation, 6.5%, that would mean that the rate on the U.S. 10-year Treasury would rise from 1.5% to some number like 7.25%. Think about the impact of a quadrupling of interest charge on the U.S. federal budget, on state and local budgets, and on credit card debt. If you want to have more fun, traditionally the U.S. 30-year fixed mortgage rate has traded at a premium to the U.S. 10-year Treasury. If they really normalized in the truest sense of the word, then the first mortgage rate that American homeowners would pay would have an 8 handle on it rather than a 2.75 handle. If they normalized, I suspect that the affordability of entry-level housing in the United States would decline by in excess of 50%. Which means that home prices, at least in the entry-level home area where traditionally younger buyers are much more heavily leveraged, would decline by 50%. Now, everybody wants more affordable housing, but nobody wants their own housing to become more affordable. If they already own it, they don't like it. So I think the probability that they can actualize normalization, as you and I might think of the word normalization, is nil. I think that what their idea of normalization is to, sort of Xanax the population to the extent where they believe that artificially low interest rates and public distortion of the economy is normal.
Yeah, that's a great point of view. As you were saying this, the other half of inflation that I was thinking about are the supply issues. Say the Fed goes all in with this raising interest rates and things, but yet the supply side there's still issues. The Fed is not going to get the outlook that they're trying to achieve, would they?
I think the outlook that they're trying to achieve is not in their term. I think everybody realizes that there will need to be a reckoning. And I think what the Fed and Congress is trying to achieve is that this reckoning will be postponed and that it will be lessened by some strength in the economy. I don't happen to be one, Patrick, who is a real sort of doom and gloomer. I actually believe 15 years from now or 20 years from now, the world will be a better place, that the best companies in society will sell at substantially higher prices than they do now. I don't believe in the end of Western civilization or anything like that. What I believe is that we have to have a reckoning. Normally, after a very, very, very long party, we've had a 40-year long party, there's a hangover. That's the way, at least when I was young and partied, that parties ended. What we seem to be doing right now is substituting vodka for rum in the punch and financing the hangover. And I think we need to get through this period of hangover. My hope is that there is continued increases in productivity among humankind, that there's a resumption of freer trade, a lessening of hostility between various population blocks, China and the United States being an example, and a circumstance where individual creativity amortizes collective stupidity. The world is still a place where 6 young people can commandeer a garage in Sunnyvale, California, and out pops Google, which means that for the last 40 years, increases in technology, increases in productivity, individual initiative has financed our collective stupidity. And my hope is that there are collections of teenagers in Lagos, in Chongqing, in Manila, in La Paz, and that this proliferation of garages around the world unleashes enough productivity enhancement that we can afford the collective stupidity that we've inflicted on each other for the last 40 years. That's my best hope.
Amen to that. Rick, going forward, though, how do you think the push for, let's say, electric vehicles are going to affect miners? I mean, notably copper, which recently made all-time highs and is used for the wiring and the windings in things like motors. And then you also have nickel, which also has made some pretty good gains recently and having a bigger and bigger role for the battery in electric vehicles.
I like the thrust of your question, but I agree with your presumed conclusion, which is to say that the electrification of the world profoundly changes the mining business. I would divorce my answer from electric vehicles, which I think actually will be a fairly minor component. Many of your listeners won't know, Patrick, that 1.2 billion people worldwide have no access to electricity at all. Another 2 billion people have intermittent access or access to electricity that they can't afford. The poorest half of humankind has made enormous strides forward in the last 30 years. And God willing, will have enormous strides forward in the next 30 years. And it will be this, not the electric vehicle, that changes fundamentally the electric economy. You, who enjoy a Western standard of living, will enjoy increasing electrification, and the economic class immediately below you aspires to live the same life that you live. And over 30 years, God willing, they achieve it. The most dramatic increase, though, will occur in the bottom half of humanity. If you look back over 35 years and you see the result of Deng Xiaoping saying to become rich is glorious and the urbanization, the electrification of China, you will see a process that needs to be repeated in Bolivia, in Venezuela, in Zimbabwe, in Burkina Faso, in Afghanistan, and it will. And it is this, the electrification of everything, that will change what we're looking at. And this will be profound for the mining business. Profound particularly because for the last 25 years, we haven't invested enough, anywhere near enough, in the materials that will be necessary for the transformation of the lives of the poorest of the poor. So even if demand for copper stays flat, even if demand for nickel stays flat and doesn't grow for 5 years, the supply will decline and the prices will rise. When we look to other components of the electric revolution, in particular things like cobalt and vanadium, here you're seeing demand growth increase very substantially, but you're seeing even greater supply challenges. So it's a wonderful opportunity for those of us who invest and speculate in mining, and a very profound challenge for fabricators who need to use these materials to produce products that increase the material standard of living of the 3 billion poorest people on the planet.
Rick, I also know you're looking at uranium. For quite a few of us, when we hear uranium and think of, nuclear bombs, we think of Chernobyl, Fukushima. But where is the demand coming from for uranium? And should we erase those memories, considering in going green, nuclear may actually be the greenest of the green?
Well, if you're concerned about carbon loadings and global warming, which I am, if you are worried about the byproducts of increased heavy metal production, which I am, if you are worried about pumping other particulate pollution into the air and the water, which I am, you should welcome nuclear. Nuclear power misused or nuclear power around an accident produces some scary and well-publicized problems. It's worthy to note that natural gas explosions every year, probably every quarter, kill many more people than have been killed in the generation of nuclear power since the beginning of humankind. It should be noted, too, that conventional wars or conventional insurgencies, including the one that we just experienced in Afghanistan, kill more people every quarter than were killed at Hiroshima and Nagasaki. So you need to put the threats associated with nuclear power in a box and consider them relative to the benefits. Nuclear power is an extraordinarily efficient fuel in the sense that a little bit of it goes a long way. So for places like Korea, Japan, Taiwan, that have very little access to natural resources, the only way that they can affect a national policy of energy security is with uranium, because you can store 10 years worth of power in a fairly small warehouse, which you couldn't do with coal or natural gas, or certainly with rain or wind, because it doesn't store particularly well. So there's that. The second thing is that you produce extraordinarily reliable and cheap baseload power with no carbon generation. The leadership of the People's Republic of China has stated publicly that 500,000 people a year in China die from airborne particulate pollution, much of which occurs as a consequence of burning oil and burning coal to generate power. And they have said that one of their number one policy prescriptions, or priorities, pardon me, is to reduce mortality. This doesn't mean the visual impact of smog, but rather mortality on the Chinese population. The consequence of that is that while the Chinese are continuing to build out their coal-powered fleet, because they still have insufficient electricity for their economy and for their population, their emphasis is on nuclear power. So irrespective of what some people might think about nuclear power, it is going to become increasingly important. One need only look at the German response to Fukushima, which was to cut down their nuclear plant and see what happened. Electricity prices for German ratepayers increased by 500%. The German power industry increased their coal consumption, doubled it, which meant that they blew away any chance that they might have of their Kyoto carbon protocols. And German imports of electricity increased, particularly from Poland, coal-fired, and France, nuclear. I think the German experience is indicative of what the developed world will see should they attempt to de-emphasize nuclear power, which is to say their taxpayers will be penalized, their ratepayers will be penalized, and they'll fail anyway. Does the wind need more wind power? Yes. Does the world need more solar power? Yes. Does the world need more hydropower? Yes. Will the world burn more coal? Yes. Does the world need nuclear? Yes.
Yeah, it's a great point again there. And Rick, you've also been known to say to hang on to cash. Why should people hold on to a currency that is losing its purchasing power year after year? And some might say being inflated away, devalued. What's the reason to hold
That's
cash?
a fantastic question. And let's acknowledge, first of all, the irony. It is true that holding cash diminishes your purchasing power annually. It is guaranteed that if you hold cash, your purchasing power declines. I believe that there are so many conflicting forces in society, in the economy, that at the very least we can expect volatility. I note, too, that in my 45 or 50-year investing career, I've been through 5 periods where, irrespective of the cause, broad equity markets have fallen between 40 and 50%. If you have a liquidity-driven market trauma, like the brief one we had in March 2020, or the broader one we had in 2008, when you have a liquidity squeeze, there's nothing that gets you through it like liquidity. If you have cash, you have the tools, and you may or may not have the courage to employ that cash when asset prices sell off by 50 or 60%. I still personally remember the crash of 2008 with some fondness, because I came into that crash with a lot of liquidity. The consequence of having both the cash and having experienced it before gave me the courage to take advantage of that liquidity squeeze rather than being taken advantage of by that liquidity squeeze. Your more sophisticated listeners, I would encourage to view the cost of negative interest rates on their savings as an option premium. If you have the cash, you have the option to take advantage of liquidity squeezes that I think are much more likely than not to occur. On a personal note, I guess, at age 68, running up hard on 69, cash is a soporific. It helps me sleep nights and stay calm. I've had periods of time in my life, Patrick, when I had a lot of cash, and I've had periods of time in my life when I didn't have much cash. And I preferred those periods when I had more cash. And this is one of those.
Rick, what is your outlook for 2022? What are you most positive about, and what concerns you about 2022?
I'm positive, I think. I guess what I'm really positive about is the disintermediation of information. It used to be that information was handed to us from the top down by government, by the academy, the universities, and by the big press. With the internet, services like yours, Silver, Bullion TV, there's a million points of light. Some of them are preposterous. But the distribution of information, the fact that information doesn't come from the big thinkers, but rather occurs peer-to-peer, is, to me, the most hopeful sign I see on the horizon. I've always been attracted to the science fiction concept of the organization of humankind into philes, P-H-Y-L-E-S, which is to say that we often have more in common with each other across national boundaries than we do within national boundaries. And the disintermediation of information gives us the ability to build connections with people irrespective of race, color, religion, nationality, all these false barriers, and begin to build connections across value and philosophy, which I think are much more important. And I think that that's a hugely, hugely, hugely misunderstood positive. The idea that people could cooperatively decide on mediums of exchange, cryptocurrency is an example, if they felt like that, or silver, if they felt like something else, that they could organize peacefully across national boundaries to affect trade, that young people in Silicon Valley could collaborate with young people in Lagos, Nigeria, and use Western protocols to solve African needs. I'm seeing this happen in real time, Patrick. I'm watching this occur. And it's hugely, hugely, hugely positive. The tools that people have to affect their own empowerment and their own education, which they can attract from each other rather than have delivered to them by the World Economic Forum or some other band of frauds, I think is spectacular. The bad news is that people still seem to prefer to think that the big thinkers have their back. Rather than take advantage of distributed media, rather than take advantage of the opportunities for individual initiative, many people in the world still want to believe that the Fed has their back. They still want to believe that Trump was better than Obama, or that Biden is better than Trump, or that any of them are anything other than a collective to steal their savings and deprive them of their freedom. It is this slavish faith in the collective, this slavish faith in government, this slavish faith in a system of increasing central control that's proven to be, so successful in Soviet Russia and Maoist China and Castro's Cuba and Zimbabwe. I mean, this thesis has been proven false every time it's been tried for my whole life. And the fact that people continue to believe that if people who are attractive to them lie and cheat and steal around a narrative that's attractive to them, that's a good thing. That's very lofty, for your listeners. I think what your listeners need to understand is that we are in the early stages of a natural resource bull market. That's inevitable. It could be postponed by a global recession or global depression, something that cut into demand. But the fact is that supplies are going to become increasingly constrained. In a normalized environment, that means that prices are going to go up. And in precious metals, while the precious metals may suffer, I'm not saying they will, but while they may suffer next year, from an increase in nominal interest rates, an increase in precious metals prices is, from my point of view, almost inevitable. Precious metals prices rise when people are concerned about the maintenance of purchasing power in their fiat and conventional savings products. Let's look at that. Quantitative easing. 40% of the US dollars in existence have come into existence in the last 2 years. Is that because the US economy has grown 40% in size? Of course not. Quantitative easing is counterfeiting. That's what it is. And counterfeiting should make you concerned about the currency. Debt and deficits. Precious metals investors need to think about debt and deficits. In the U.S., the on- and off-balance sheet liabilities net present value of the U.S. government exceeds $150 trillion. And we pay this debt with a budget that's in deficit $4 trillion a year. I'll leave that one alone. But the most pernicious, or from the point of view of precious metals investors, the most promising, oddly, is negative real interest rates. The idea that savers should pay spenders to consume now while savers defer enjoyment and take credit risk is truly insane. And the consequence of that, I think, is higher precious metals prices. Another piece of arithmetic, Patrick, you're going to be sorry you asked me this question. Another piece of arithmetic is that the market share of precious metals and precious metals related investments, despite their attributes, is at an all-time low, which is to say fear is at an all-time low. It is estimated that the market share of precious metals and precious metals related securities in the United States is 0.5% of the value of total savings and investment assets in the country. The 3-decade mean exceeds 1.5%. If quantitative easing, debtor deficits, and negative real interest rates increase the appreciation for precious metals, all they have to do is revert to mean. And if they revert to mean, demand for this asset class will triple. I actually think it will overcorrect. In other words, I think it'll overshoot mean because that's the way mean reversion works. And if you think about the impact that that would have on the prices of precious metals and precious metals related securities, you get some sense of what I expect will happen, perhaps not in 2022, but certainly will happen over the next 5 years. If you look at a history of precious metals bull markets, Patrick, the 2000 to 2011 bull market, the 1970 to 1971 bull market, what you see is that they're not 2 or 3 year long affairs, they're 10-year long affairs. We're perhaps 3.5 years into it. And the dimension is unbelievable. The 2000 bull market, the gold price went from what, $253 an ounce to $1,900? The silver price went from $5 to $50. I'm not saying that past is prologue. I'm not saying that the precious metals prices will necessarily increase sixfold. But I think they'll increase by more, at least in nominal terms, than other people believe they will. Because I think the arithmetic supports it, even though the narrative is hostile to it.
Yeah, Rick, those are some pretty encouraging words, though. Appreciate that. And before we wrap up, can you let our listeners know where they can find you on the web and follow you on social media?
I sure can, and thank you for that. I'll give them an incentive, as I always do. Any of your listeners who care about my view on natural resources and precious metals can personalize it. If you go to a website, ruleinvestmentmedia.com, you can enter your natural resource stock portfolio there, and I personally will rank it 1 to 10. 1 being best, 10 being worst. Please, 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 no crypto. Please, no pot stocks. Please, no tech stocks, just natural resources. On those, I'll rank them, as I say, and I will also, if you wish, add comments on individual issues where I think my comments might have value. In addition to that, Patrick, your listeners have always liked it when I include some visual tools, some charts. And so anybody who mentions charts in the question line will receive a copy of the Barron's Gold Mining Index going back 60 years, the most all-inclusive gold equity index on the planet, which is a great visual tool to understand the anatomy of gold bull markets and gold bear markets. And in addition, a 110-year-long commodity chart, which talks about the prices of general commodities like copper and oil relative to other savings and investment products that are available to investors. Just mention charts. And I will happily include that. The third thing I'm able to include now that I'm not securities licensed, not regulated, if any of your listeners are accredited and participate in private placements, all you need to do in the comment line is say private placements, please. And I will, because I'm allowed to by law now, give you notification of private placements that I personally am going to participate in. Note that I'm not a broker anymore. I'm not an investment banker anymore. So this doesn't constitute advertising anymore. I'm not raising money for myself. It's just what I'm doing with my own money. So for any of your listeners who are accredited and who are interested in private placements, if you say in the question or comment place, private placements, please, I'll build up a database and I will distribute information about those which I'm doing with my own money. It doesn't propose to be a service that reviews every private placement in the world. All I'm doing is notifying you when I'm going to write a check.
Charts and private placements. Remember that, guys. Be sure to put that in there when you contact Rick Rule. Rick, we thank you for your time, and I want to wish you a Merry Christmas, and I hope we can do this again soon in a positive 2022.
Patrick, I'm going to do a lot fewer, or I'm going to do the same number of interviews, but I'm going to do them with a lot fewer people next year. So I'd like you to be on that list. I'd like to interview with you more frequently and with some other platform sponsors less frequently.
All All right, you got it. I'm sure the viewers will absolutely love that too. But Rick, you're one guy that I know a lot of people do look up to, and you've always been a straight shooter with them, and that's why a lot of them out there really love you and appreciate what you do.
Thank you, Patrick. I'm delighted, frankly, in retirement to not be involved in any regulated activities. The idea that I can have an interview like this unconstrained by what the SEC might think of it is very pleasant.
I guess it's me. I'm the one that's constrained by YouTube and the rest of those guys, so I got to be careful of what I say too. But Rick, again, we appreciate it, and I hope we can do it again soon.
Always a pleasure. Thank you.
That was Rick Rule sharing his views on the economy and the resource sector. To follow more of Rick's work, please visit www.ruleinvestmentmedia.com. If you like this video, please subscribe, share, and give it a thumbs up to let the YouTube algos know we're giving value to you. Audio-only versions can be found on iTunes and Spotify.